Just to introduce our presenters today, Abby Chalopin. Abby is one of our tax directors. Abby's been on the PCA's State Taxes Committee for a number of years and has been heavily involved in the consultation around the CIPT. We also have Blake Rogers from our business and private client area. Blake acts for a number of residential and commercial property developers, and he's sort of been looking at these rules from that angle. And we also have Robert Parker. Robert is very experienced. Rob's specialises in indirect taxes, gives a lot of practical advice in this space, and he's a member of the Law Institute Victoria's State Taxes Committee. So Rob also really understands the technical details of this. Rob will be a panelist today asking questions, and both Abby and Blake will be presenters. Slide. Okay, so just to give you a bit of an overview of what we're going to cover today, I'll give a bit of an introduction. Obviously, CIPT, or the Commercial and Industrial Property Tax, is the biggest tax change in Victoria, in Victorian property taxes in my working life. So it is going, and I'm a specialist in sort of taxes, so therefore we're looking at these things all the time. It took me about a week to really lock in how all these things work really well. So for people in the room today, I'll give the overview to the high level, because I think the high level concepts, if you've got those in your head, then the rest of it sort of falls through pretty well. Abby will then run through a lot of the technical nuances and issues that we found that will be popping up out of the legislation. And then at the end, Blake's going to cover the change of use issues, because when you're converting from commercial to residential, and also just highlight who are the winners and who are the losers. We don't think there's too many winners out of this. There can be some losers, but there are some. You'll have to do your own financial modelling to see whether you can actually have a situation where you win out of the regime. Now, I think this is the most important slide for people who are not doing tax day in, day out. You really need to understand this concept. So we've just brought this out at the start just to highlight the key things you should know about it in this new regime. So the first thing is it kicks off from 1 July 2024. So for any arrangement that's entered into before that date, it's not part of the new regime for CIPT. So if you want to, so one of the big questions you'll ask yourself is, do I want to sign a contract or enter into an arrangement before 30 June this year or not? Does that give me an advantage or a disadvantage? So that's probably one of the biggest questions people in the room have to answer. So once you enter into arrangement after 1 July 2024, then you're into the new regime. And what does that mean? So on settlement date, you effectively would still have to pay duty like you ordinarily pay duty. But that's the last time you should have to pay duty once you're into this regime. So you then have to wait 10 years. So you pay duty once, then 10 years later, you have to start paying an annual CIPT after that 10-year period. But it's only aligned with your land tax assessment. So therefore, CIPT is based on the site value of land, whereas duty is based on the market value. So it's off a lower base, but in 10 years' time, you might find the value of the land's high, the site value is as high as what you paid for it 10 years earlier. So effectively, in your land tax assessment, they'll issue you with an extra 1% CIPT. So that's sort of the broad basic thing you need to consider. As we've said there's also a loan scheme that the government's going to put in place. I think this has been brought in so they can transition people to start thinking that they're in a CIPT regime. So effectively, that if your purchase is below $30 million, they'll lend you the money at what we expect to be below market rates, but they're not going to be massively below market rates. And we don't know how the banks are going to deal with it. We do have Georgia in the room, so she can tell you once they make their mind up on how the banks will deal with CIPT. But this is still just draft legislation, and things can change. I think that's the most important thing for us to consider. So now what I'll do is I'll hand over to Abby, and Abby can then run through the details of these components. And for the people in the room, I've sort of left that on the board over there. So as we're going through it, you can refresh your mind. It might be behind Blake, it might be hard to see it, but it's a good reminder for you.
Did the people at the back want to come grab a chair? Oh, you can feel free to eat. It's all good. We've got the front.
No worries. Right, I might start out just with a snapshot as to where we're at. So the bill is currently before the Parliament. We did, through the PCA and Law Institute and various other bodies, provide some feedback about various issues. But I think it's fair to say that we don't expect there to be significant changes from the bill that we've also had a look at. And as Stephen said, the Act will become effective from 1 July 2024. So it's not long till it kicks in. So it doesn't give us much time to think about the question that Stephen posed as to whether we should be entering into contracts prior to 30 June. So it's only a couple of months to go. Just another legislation that's sort of been dropped quite late in the piece with a start date not too far away. It's always frustrating. So what land is caught? Land that's deemed to have a qualifying use. So that is land that's been allocated an Australian valuation property classification code in the ranges that I've listed there. So commercial industrial is the aim there. In terms of where you can find that code, it's in your rates and valuation notice. So if you wanted to check whether your particular property falls within those codes, you should be able to see that code in your notice. So we do expect it to apply quite broadly. You know, it would apply to obviously office, shopping centres, your warehouses, your factories, your medical centres, hotels, just as an example. It will also apply to vacant land that's either got a permit or is capable of being commercial or industrial property. The things that we expect to be excluded are things like, well, residential is clear, retirement villages, hospitals, education facilities such as childcare, schools, universities, research facilities, sporting complexes. They're all expected to be excluded. A lot of those are kind of exempt from stamp duty, so I suspect that's why they've fallen into that bucket, obviously not residential. And if you've got a situation where you've got more than one code allocated to your property, obviously for mixed use purposes, you do need to look at what's the sole or primary use of that particular property. So if it is considered to have a sole or primary use of commercial industrial, the whole property will be subject to the CIPT, so including the bit that's not commercial and industrial. So that can be quite a tricky thing to work out, what's the sole or primary use. We are hoping that the SRO will provide some guidance on this issue because there's various factors that you could use. Obviously, you could use comparable area size land. You could use, you know, what's the most intensive use of the property. You could use revenue. So there's various sort of ways you can work that out, and we are hoping that there will be some guidance on that. Student accommodation is something that is captured. So where the land is solely or primarily used for student accommodation, it will be captured. And so, Rob, where we've got a situation where we've got a university that owns student accommodation, do we expect that that would be captured by the new regime?
Well, that's subject to being commercial accommodation under the GST Act. So goes by according to its GST classification. If it's student accommodation and it's for university students there and it's commercial residential, then yes, it falls within the regime.
Thanks, Rob. So moving on to what will sort of trigger your land to come into the regime. So there's three ways that it can enter the regime. The first is an entry transaction. Second is an entry consolidation, and lastly, an entry subdivision. So I'll go through each one of these. So the entry transaction will include what you'd expect, which is dutiable transfers. So dutiable transactions which involve an interest of 50% or more in land will be caught by the new regime, but not the transfer or assignment of a lease or the acquisition of an economic entitlement. So these are two carve-outs from the CIPT regime, and Rob will discuss later what that will mean. Also, what's not within the regime, as you would expect, is anything that's currently exempt from duty, whether the transaction's exempt from duty or whether the corporate reconstruction or consolidation exemption will apply. Also, what's carved out is transactions where it is pursuant to an agreement that's entered into prior to 1 July 2024. So obviously, Rob, if we sign a contract today, that's clearly would be outside of the CIPT regime. What about things like an option agreement or a contract that maybe have some conditions attached to it?
Well, I've used this transitional wording before, agreement or arrangement. The Commission has taken the view that an arrangement is broader than an agreement. So it can include something less than a formal contract, but it has to have a degree of certainty about it. So it has to effectively have a fixed price or a price that can be fixed by some external mechanism. So I think they'll probably accept that options will be an agreement or arrangement as long as the price is fixed. Probably also heads of agreement, things like that. As long as they're relatively certain, they'll probably fall within the transitional exclusion.
That's probably something worth just confirming. Obviously, if you are trying to get out of the regime, so you're entering something other than a signed contract for purchase, a good idea to just confirm that what you've entered into would be valid to be considered an arrangement or agreement prior to July 2024. The other way to enter into the scheme is through landholder acquisitions of 50% or more. So again, if it's exempt under the landholder provisions or exempt for any other purpose, it will also be exempt from entering into the CIPT scheme. And also if you've entered into the agreement to purchase an interest in the landholder entity prior to 1 July 2024, you will also not be caught within the scheme. So because landholders are a little bit more complicated, we thought it would be worthwhile just going through a couple of examples. So the first example is the situation where we've got Prop Invest Pty Limited, who's got a 15% interest in Landhold Pty Limited prior to 1 July 2024. And they did acquire that interest at a time after the land was purchased by the entity. So on 1st of September 2024, Prop Investment Pty Limited acquires another 35% in the company. So the aggregate acquisition that they now hold is 50%. This will be a trigger to enter into the CIPT scheme. So I guess this example is there to show that even if you've got an interest prior to 1 July 2024 for landholder situations, you still need to be conscious that if you do acquire further interest, you can still enter into the CIPT scheme. The second situation is just to sort of highlight kind of what it means like the funds, for example, where you've got various unit holders, or even like private unit trust where you've got a few different parties holding units in the trust. So we've got various unit holders holding units in the trust pre 1 July 2024. And then you've got an entity that comes along, Prop Invest Pty Limited, who acquires a 50% interest in the unit trust. This will trigger this particular piece of land that the unit trust holds to enter into the CIPT scheme. So it's the land that's the relevant that will enter into the scheme, and the landhold unit trust will be paying the stamp duty, and then it will also pay the CIPT after 10 years. So the thing to highlight here is that
Prop Invest who pays the duty.
Yeah, Property Invest pays the duty, but the unit trust will be liable for the CIPT. So the thing to highlight here is that the remaining unit holders whose interest hasn't changed prior to 1 July 2024, and they haven't sort of transacted at all, and they don't even have an interest of over 50%, will be liable to the CIPT due to having an interest in a trust that's having to pay that duty. So consolidations is another way to enter into the regime. So where you've got a situation where more than 50% of the area that's been consolidated is tax reform scheme land, the consolidated land will be tax reform scheme land and it will enter into the scheme. So in our little example, if we've got, if we assume that all plots have the same size, if plot 1, 2 and 3 are all tax reform scheme lands, so they've been purchased after 1 July 2024, and then you've got plot 4 which isn't, and you consolidate all 4 plots, the consolidated land will be considered tax reform scheme land because more than 50% of the land is tax reform scheme land. And the date in which it will enter the scheme will be the date in which the first plot entered the scheme. So if plot 2, say, was acquired on 1 July 24 and plot 3 was acquired, 1 July 2025, as an example, the whole consolidated land enters the scheme on 1 July 24, being the first date that the first property entered into the scheme. So this is a little bit complicated, but hopefully that makes a bit of sense. On the other hand, if you've got a situation where you've got these 4 plots, but only plot 4 was tax reform scheme land, so the remaining 3 plots are not tax reform scheme land, when you consolidate, it will fall out of the CIPT regime. So the whole consolidated land will not be part of the CIPT regime. That's consolidation. Subdivision's a little bit simpler. So if you've got a parent lot that's already part of the new regime and you subdivide that into 4 child lots, all the child lots will be part of the regime, so they'll all be subject to the CIPT, and the date that they would have entered into the scheme would be the date that the parent lot entered the scheme. So let's say it entered in 1st of July 2024. From the settlement date of that transaction, all 4 lots will have to pay CIPT 10 years after that. So just some key information on the CIPT. It is separate from land tax, so the land tax will continue to apply. It will apply for 10 years after the land becomes tax reform scheme land. So if it's just a normal purchase situation, 10 years from the settlement date of that property acquisition. As Stephen said, it is assessable annually and on site value and based on the ownership of the land as at 31 December. The rate will be 1% of the site value for all land other than built to rent land and 0.5% for built to rent land. Existing land tax exemptions will still apply. So if your property is currently exempt from land tax, it will also be exempt from the CIPT. Unpaid CIPT will be a first charge on the land. And I understand that the property clearance certificate that the SRO will provide will state whether the particular property is part of the CIPT scheme, and it will also disclose any unpaid CIPT, so purchasers are able to access that information. Also understand that there'll be additional requirements in the section 32 to state whether a particular land is tax reform scheme land and part of the CIPT. Just like land tax, you can't pass on the CIPT for leases under the Retail Leases Act. And foreign surcharges, thankfully, don't apply to the CIPT. Obviously, if it falls out of the CIPT and it becomes residential, then you will be subject to both duty and foreign surcharge duty, and that can get quite complicated. Rob, is there any other sort of observations on the general CIPT that you wanted to note?
I'll just make the observation also that there's a prohibition on adjustments under the Sale of Land Act. So just the same as you can't adjust for land tax in Victoria now, you won't be able to adjust for CIPT.
I think that's for less than 10 million.
So you get less than 10 million. Yeah. So it aligns with the current restrictions on the Sale of Land Act.
I just pause for a second, and is there any questions on that so far that anyone in the room has?
Question regarding the BTR. You talk about the BTR land versus non-BTR land. We're yet to see BTR transacting in Australia, but once they start transacting, becoming asset class, would that be a 0.5 or would that be subject to different duties?
Look, BTR land is probably not going to fall in any of those codes anyway. It's in there, but we had a discussion about it. It's highly unlikely to fall in the CIPT regime because it'll be residential, not commercial or industrial. There might be some marginal developments, mixed purpose, where it satisfies BTR and also falls in CIPT, but unlikely. Did you want to add anything, Steve?
They just say there's a shopping centre and they decide I've got some space on the side, we're going to build some BTR on that same site, and it's still majority commercial industrial, and you have a small portion of BTR. That's the only scenario it could probably apply in.
So we think they'll apportion it in that
Yeah,
situation.
that apportion on that
The
BTR. yeah.
accommodation subject to the tax, BTR with the students occupying, kind of.
Yeah, different regime, yeah.
Sorry, you had a question?
Yes. Has there been any explanation how they're going to calculate the site value? Is it the same basis as what they do land tax?
So same as land tax, yeah.
Yes, I guess the objection process will be the same as well. If you're not happy with the site value, that's on the notice. Yeah.
So what was the rate? Just on the previous slide, you had the analysis of
Yeah, 1% of site value.
1% of site
Yeah,
value on
yeah.
top of your land tax.
Yes, that's right. Yeah.
Another question.
Yeah.
On that mixed use example, I mean, if you've got residential and commercial, what's the sort of threshold at which point it will be considered eligible?
Yeah, I think that's the bit that we're hoping for some guidance, because it'll come down to whether it's solely or primarily used for commercial and industrial. So like I mentioned, there's various ways to work that out, but I'm pretty sure, Rob, we do think the FRL is going to issue a ruling on that one. We're hopeful, yeah.
Yeah, look, I think they will, and they've said that they will be doing some information sessions, rulings, etc. But I think the short answer is where you've got a mixture of commercial, industrial, or commercial, residential, you're likely to have separately rated properties anyway. And so they just fall into, one will be subject to CIPT and the other one won't. It's only where you've got a single title, single occupancy, and it's rated as a single property, which you'll have mixed use.
So that's primarily more than 50%, but 50% of what? Is it land? Is it the
Well,
market value? What is it? That's the question. It's not clear.
Yeah. I suspect it's going to be site value, but who knows?
I might take your last question.
I was just going to ask, in the instance where an individual transfers, let's say 50, 60 or 50% from their entity into a superannuation entity, does that trigger the, it's the same entity, it's recognised?
They're
Same
interested in the
beneficiaries.
landholder.
Yeah.
If the transfer to the super fund is exempt, it just stays outside the regime.
Right.
If it's subject to normal duty, then transfer of 50% or more will
Trigger that.
cause it to enter into the CIPT regime.
It goes from an individual's name to an individual super fund and doesn't attract.
Well, there is an exemption.
Yeah,
there
exactly
is,
what Rob's saying. If it's exempt in
it's
the first place, then
Yeah,
you don't have
okay.
to worry about the CIPT. Yeah. Actually, something I forgot to mention with that 50% threshold, it's the normal aggregation rules do apply. So you do need to aggregate with any interest acquired by associated persons or in an associated transaction. So that's something to keep in mind when you're working out whether you have acquired a 50% interest.
Sorry, Abby, I might just emphasise what you mentioned before. CIPT works on the basis that it's taxable land under the Land Tax Act. So the existing exemptions all apply to CIPT also. The stamp duty exemptions don't align, so you might have transactions which are subject to duty and then result in no CIPT because it's not taxable land. So there's not necessarily an alignment between the two, or there's some mismatches.
But in general, we think if it's exempt from duty in the first place, it would be exempt.
So
from
charity,
the
things like that.
Yeah. All right, might keep going, but we'll have more question time at the end. So where does this leave us with stamp duty going forward? So stamp duty will still apply to land that's not listed within those ABPCC ranges, so residential and all the other sort of properties that I mentioned before. The entry transaction will be subject to stamp duty. So the first purchaser, in simple terms, who purchases the property after 1 July 2024, they will have to pay stamp duty. So they're the unlucky person who, if they hold that for 10 years, they've got to pay the stamp duty and the CIPT. Those purchasers will have the option, and Stephen mentioned this, to pay for that duty either as an upfront lump sum, or there is going to be available a government loan, and I'll go through that in the next slide. After that first entry into the scheme, subsequent sales and transactions should be exempt from duty as long as the scheme remains a CIPT land. So as long as you continue to use it predominantly for commercial and industrial use. The grant, as I mentioned briefly before, the grant of a dutable lease and the creation of an economic entitlement will still unfortunately be subject to duty. And Rob, we do expect that this is going to cause a few issues. And I guess what sort of issues do you see arising? And do you think there's any hope that they might carve this out in the final
Well, we're
legislation?
hopeful that they will. Both those provisions, economic entitlements and grant of long-term leases for premiums or other consideration, they're intended as anti-avoidance provisions. So it's anomalous that you're taxing what is an anti-avoidance provision when you can tax them, you can transfer the title without duty in the first place. As you're probably aware, Treasury put out some consultation papers on this a while back, and they just excluded economic entitlements and grant of leases entirely. But I think the Property Council is following up and the Law Institute's following up, saying this is just anomalous.
Yeah,
They should just be included.
fingers crossed.
I hope
If they don't change the law, you just transfer the title. Don't worry, don't do an economic entitlement.
yes.
Probably worth pointing out that an economic entitlement transaction doesn't necessarily, or it won't create an entry into the scheme either.
No.
So that won't be considered to be the first transaction if there is an economic entitlement transaction after 1 July 2024.
So in fact, you could use it as a mechanism to avoid going into the scheme. So
Yeah, hopefully they'll take that out in the final bill. Certain landholder acquisitions and unit trusts will still be subject to duty, because as I mentioned, the trigger point to enter into the CIPT scheme is 50% for landholder acquisitions. In Victoria, we do have a 20% threshold to enter into the landholder scheme. So if you did acquire, if a person acquired an interest of say 30% in a landholder, and the landholder holds land that's CIPT, which is subject to the CIPT, that person will still have to pay duty on that 30% acquisition. So it's just something to keep in mind, that with landholder duty, it will still continue in some way or form, even if the land is subject to the new scheme. And finally, Rob, with sub-sales and nominations, is there anything that we need to be conscious of with respect to the new regime?
well, there's plenty to be conscious of, but the legislation doesn't alter any of the existing assessment provisions. So if you trip up under the sub-sale provisions where they're subject to double duty, and that's where you do a nomination under a contract of sale, where there's been land development or options and land development. If you do a nomination, you can end up with double duty. Those provisions don't change, so you can end up with double duty. It will enter into the CIPT scheme, but you're probably better to just do a settlement under the original contract and then do a second transfer to your nominee, which will be exempt from duty.
That's just one to keep an eye out to structure appropriately and get the best outcome.
So again, there's been representations made that should just result in one lot of duty, whether or not the government amends something in that. In the upper house, who knows?
So as mentioned, there will be, for the first purchase after 1 July 2024, a government facilitated loan will be available. I've just noted the criteria on the slide. The bill makes it quite clear that there's no obligation for the government to provide the loan, even if the criteria is satisfied, but you can apply for the loan and see how you go. The loan will be subject to interest, and you will need to make annual repayments over the 10 years of that, which is basically the stamp duty spread over the 10 years.
I think you've got to pass a Treasury credit
Rating,
approved.
yeah. So when the property is sold or it becomes a non-qualifying use, you will have to repay that land. So I mean, it's repay the loan. So you can't pass on the loan to the next purchaser, as an example. And the loan will be a first charge on the borrower's interest in the land. So duty exemptions. So I guess one thing to keep in mind is if the purchase that's triggered the entry into the CIPT scheme is 100% interest in land, then no further duty will be payable as long as the land remains within the CIPT scheme. If the tax reform scheme land has entered in through a transaction of less than 100%, there are two situations where no duty will be payable. And the first one is that there'll be no further duty payable in relation to a transaction that's already entered into the scheme. And I'll go through it in the example so it'll make a bit of sense. And there will also be no further duty payable if the transaction occurs more than 3 years after the land first enters the scheme. So I think both of those are best talked through by this example. So in this example, Property Investco acquires 50% interest in land on 1st of March 2025. And then they acquire further 20% interest on 1st of March 2026. So, sorry, I should say the land will enter into the scheme on the 1st of March 2025. When they acquire that interest of 20%, they will need to pay stamp duty on that 20%. So I've got two scenarios here. The first scenario is on 1st of July 2017, sorry, 2027, going back in time, which is within the 3-year period. If a development co comes along and purchases 100% of the property, they will still have to pay duty on the 30% that's never been subject to duty. So we've had 70% of duty being paid by Property Investco and 30% hasn't been subject to duty. So when the development co comes along and purchases that 100%, they will have to pay that duty on that 30%. And but they won't have to pay it again on the 70%, which has already been subject to duty. And then on this slide, we've also got a scenario B, which explains that 3-year scenario. So after the 3 years, on 1st of July 2029, if the development co comes in and purchases 100% of the property, they will have to pay no duty. So there's no duty on the 70%, there's no duty on the 30%. So that's a pretty good result for the development co. And if they do develop the property and they sell it before the CIPT levy sort of kicks in, which will be 1st March 2035, effectively they're paying no duty and they're paying no CIPT. So I guess Blake will go into this a bit more, but I guess they're one of the winners out of this new regime.
I might perhaps point out, Abby, if you go back to that slide,
yeah,
the property certificate that you get should tell you not only whether the land's subject to CIPT, but also in the case of 1st of July 2027, it should tell you that 30% of it is not preserved.
I'll now pass it on to Blake, who will go through the change of use and some practical things to be aware of.
Thanks, Abby. Hi, everyone. So I'm going to be talking about the implications of a change of use with respect to properties that are within the regime. And I'm also going to be running through a couple of examples that are relevant to the economics of owning, buying and selling properties that have been subject to the regime. So to begin with, a change of use is relevant with respect to properties changing from being part of the scheme, in other words, from having a qualifying use, or if they cease to be commercial or industrial in nature. It's also relevant if they start to be commercial or industrial in nature through a change of use. But it's particularly relevant if they stop being commercial or industrial in nature, and they have been acquired through a transaction that was exempt from duty. So as Abby's alluded to, transactions that are not the first transaction after 1 July 2024 may be exempt from duty. And if a landowner has acquired a property that was exempt from duty because of that, and then it becomes no longer commercial or industrial in nature in its use, then at that point in time, there might be a clawback. There might be a duty implication for that landowner. So I'm going to run through an example now to show you how that could look. So if you see on the slide, this particular landowner acquired the property on 1 July 2026, which is the second last icon. And that was the second acquisition of that particular property since 1 July 2024. And because it wasn't the first, it was exempt from duty. Now, 3 years later, at the end of the slide, on 1 July 2019, there's a change of use with respect to that property. And at that point in time, there's a duty implication. So they didn't previously pay duty, but now because there's been a change of use, they will. And the amount of duty that they pay is 70% of what they would have paid if it hadn't been a dutiable transaction when they acquired it. And the reason it's 70% in this case is that there's been 3 years that have elapsed since they acquired the property, and there is a 10% per year discount on the amount of duty that's paid. So you could imagine a scenario where a property owner has owned a property for 10 plus years and they have a change of use. That duty implication would then be zero on the basis that the duty is discounted by 10% per year, and that accumulates to 100% by that point in time, albeit they will be paying the CIPT by that stage. So there might be some, I'm going to get to the winners and losers in a sec, but there might be a winner there if somebody has owned a property for 10 plus years that's in the regime and they have a change of use to, say, residential, for example. That wouldn't trigger duty, and that it could, in fact, cease the CIPT with respect to that property. It's also worth noting that there is an obligation on the landowner to notify the State Revenue Office if there has been a change of use in either direction, either from residential or some other use into a qualifying use, or from a qualifying use to a non-qualifying use. And that could be for any part of the land. There's some uncertainty at the moment as to exactly when a change of use will have occurred for a site. You could imagine a scenario where a commercial property has a tenant in it, but the owner has commenced a residential property development on the site. They've got the wheels in motion with respect to a development, that perhaps they've got a permit. In that situation, there could be a number of points in time where, in theory, there has been a change of use. And it's not entirely clear exactly which of those points in time will be the change of use time, and therefore the dutiable time potentially. So we're hoping that there'll be some more guidance released on those sorts of issues, as well as what the mechanism is for notifying the SRO under each of those different scenarios. For example, a permit might be a scenario where the SRO gets automatically notified, whereas physical works to a site, they wouldn't know about it unless there was a form completed. The other implication potentially when there's a change of use, and just to keep in mind, is that there can be other tax implications. So it's worth keeping in mind that the windfall gains tax exists now. So if a rezoning occurs at the same time, that could be relevant. You could also stop holding a property on capital account for income tax purposes and on an income account at that point in time. So there's a number of things that could occur from a tax perspective when there's a change of use. So this, I guess, is the winners versus losers, and we've got some questions on the screen there as to things to think about. But one thing that we could think about is whether it's worthwhile buying a property now before 1 July 2024 or waiting. And I think that the market is going to be made up of properties that are quarantined and have been acquired pre-1 July 2024, and people don't necessarily want to transact them if they own those properties because they're not going to be subject to the CIPT. And then there are going to be properties that have transacted since 1 July 2024, and there's this 10-year window where there's no CIPT, but they can be bought and sold without duty applying, albeit they'll be inching closer to that 10-year mark where the CIPT will come in. There's also considerations whether you're a long-term holder or a short-term holder. And there might be considerations as to whether it's a certain type of asset versus another type of asset that has different site values relative to the overall value. So we'll run through a couple of examples now looking at those things. A long-term versus short-term land holding. So in this scenario, you can see that prop long holds the property for more than 10 years and prop short doesn't. And quite clearly, the CIPT is a new tax, and that's going to mean that prop long has got more tax to pay overall. They're both paying duty in the first instance on the basis that it's the first transaction since 1 July 24. But prop long has to also pay the CIPT. So that's an obvious example. What might also be less obvious is that prop short, when they sell their property, maybe the value of their property is affected because their property is approaching that 10-year mark. So if they sold in year 9, relative to another property on the market that's not subject to the CIPT, they might be paying a cost in that way because their market value is affected. And this is the last slide, I believe, that I'll be talking to. And this is a comparison of the different asset classes that might exist. So it's a fairly simplistic example where you might have 2 properties that were acquired for the same amount, but they have different site values. So an example of that might be an industrial property versus a supermarket, where the industrial property is a simple warehouse or a shed, and the supermarket has a significant capital improvement on it that adds to its value. So if these 2 properties were acquired for $80 million, and the site values were 20 million and 40 million respectively, you can see that there's a significant difference in the CIPT that's payable. In fact, it's double, obviously, for the industrial side, which again will impact on the valuations of these properties. There's a break-even point there, and I guess that refers to property that has been acquired without duty applying. So how many instalments of the CIPT will it take to add up to the amount of duty that would have been paid if it was paid? So that's an interesting thing to think about as well. Okay, I think I'm going to hand back to Stephen now.
Blake. Okay, so there's been a lot to get through there. And I just thought one of the things to think about is why, I should have said this at the start, but why did they introduce this CIPT? Obviously, there's been a lot of economic modelling for a long time to say that the duty is inefficient and it causes friction in the market. The governments haven't really cared about that because they've always budgeted to have higher, lower collections of what's always been the case due to property increase in values or turnovers. But as we've seen the last few years, the turnover of commercial industrial property has declined and the collections haven't met budget. So this is providing the Victorian government with an opportunity to pretty much be able to predict what their tax collection is going to be and give them greater certainty. So that's one of the main reasons why it's being introduced. Now, we've got a hybrid session here, so not quite sure how questions will work, but if you're online, if you put your hand up, it will probably come up on our screen on the side, and I'll look out for those ones. If anyone online has a question, and then we'll call your name and you can ask the question. Otherwise, we'll just take questions from the room. So are there any questions that people might have at this stage? And no hands going up online.
So if you got to a 49-51 sort of split, how is it approached within there on resi and commercial if you did a development?
So you're saying 49% commercial industrial?
Either way, yeah.
Yeah.
Yeah, so if you did a mixed use, instead of having it all a hotel or all a commercial, if you put an element, i.e. 51% in there, does that then get around us?
So by putting 51% residential in,
Yes.
that would mean it doesn't come into the CIPT regime.
Yeah.
It's just a matter of working out how that 51%
So
is
that
calculated.
floor
Yeah,
code,
that's right.
yeah.
Yeah.
Is it on levels? Is it on floor space?
Yeah.
It's not.
Yeah, it's on site values, so you've got to work out how, or we think it's going to be on site
Yeah,
value.
Well,
but
it's possibly on site value, but I think you'll find in those circumstances, well, the hotel will just be separately rated, not just be treated as commercial industrial.
Yeah.
The residential, whether it's one in logo title or multiple titles, will be separate.
Yeah.
Separate properties.
Which will be
So
outside.
just the same as land tax assessment. Or separate, the value would generally be separated now based on occupancy.
And initially there's actually, within the 200s, which is the commercial section of the codes, there's a category for land that's held for redevelopment, but also within the 100s, which is the residential section of the code, there's a category for land which is held for redevelopment.
Yes.
And so it might matter which zoning it falls within at the time that you decide to do the development.
And will the BG determine that at different points? Yeah.
Not sure, but they're going to have to, yeah.
Not a question, but just a quick comment going back to the stamp duty slide. So the banks,
Do you want me to go back to it?
Go back.
yeah, so the banks, including CBA, were consulted by the government, so I was part of that working group. So just a quick comment out of many.
This slide or back further?
This
The stamp duty. Keep going.
So quick comment, if you were to,
That one?
if you were to go down the path of opting in for the GF, the government facility, GFL, that portion as a debt between the property owner and the government will form part of the bank LVR calculation.
Yeah.
And there will be scenario first and second mortgage and third priority.
Thanks. You got Rob.
Rob's good, yeah.
Robin Fidel.
From now, would you like to come off mute?
Yes, can you hear me? Abby, if you've got a situation where you've got a unit trust that owns land and it hasn't entered the CIPT regime yet, and say you parties, the unit holders, 60% of the units are transferred, I think you're saying the land then enters the CIPT.
Yeah, the whole land, yeah.
Okay, so, but there would be duty on the 60% transfer. And that's probably like a first time situation, but does that mean that the land in the unit trust is then now exempt from duty if it's sold?
The land itself.
They're subsequent to the 60% transfer. It hasn't been 100% change in ownership, but the 60% transfer brings that land in as a CIPT. If you then sell the land subsequent to that, does that mean there's no duty on the sale?
It just depends upon, there's those three different categories that are exempted. So in this one, it's not the 100%. You're talking about a 60%. So
Yep.
Your entry interest is 60%. So if you transact the land within 3 years,
Yep.
subject to duty. If the land is sold after the 3-year period, then it's outside totally.
Yeah, so that's an example we had up, Rob.
which one is it?
The 3-year, keep going, you went the wrong.
Yeah, that one.
No. Sorry. Yeah.
So
Yeah.
a 50% transfer could trigger entry into CIPT, and if you held it for longer than 3 years in the unit trust, you'd effectively then not be subject to duty on the sale of the land.
Yeah, that's that scenario.
Yep. Okay.
Keep in mind that your 10-year transition period runs from the date of the
First
50%
yeah.
transaction.
Yep. Thanks, Abby.
There's somebody else who's got their hand up, but you haven't come up on our screen. So feel free to click if you think it's you.
Yeah, it's Michael on the head.
Hi, Michael.
So if I've got this clear in my mind, if you enter into the regime after 1 July 2024 and you sell the property just say in the next 3, 5, 6 years, the incoming purchaser in 3, 4, 5, 6 years doesn't pay stamp duty. Is that right?
Provided it's still qualifying land, it's still qualifying use.
So if it's commercial industrial property, and then in 10 years, that's when the CIPT kicks in. So you can sort of have 3 or 4 sales and not trigger any duty.
Yeah. So then if you've got 2 parcels of land, one that hasn't entered in the regime yet and one that has entered into the regime, and you put up both properties for sale and assuming they've got the same value, then the propensity for someone to purchase the one that has entered into the regime will be higher, I would have thought, because they're not being asked to pay 6.5% stamp duty.
But
Yeah,
probably
comment
depend,
Blake was.
So it's going to distort values, I would have thought.
it does, but it probably depends on who the purchasers are. Like we say, there are some purchasers who just, they want to run their business from it. They're going to hold it for 40 years. Those people probably won't want to buy one that's going to go under CIPT.
If they happen to have a tenant that's able to have the CIPT passed on to them, they might not care as much as well.
Yeah, look, there'll be a whole lot of distortions in the market. So somebody's buying land for residential redevelopment, they probably don't care because they're going to pay stamp duty one way or the other. Equally, as Blake observed, land that's approaching its 10-year transition period is going to be worth less than land that's just entered into the regime and has got 9.5 years to run. So there's going to be all sorts of distortions in the market.
Okay.
I think it's important for everyone, you've got to do your modelling and you've got to model this in because the 1% of site value is not insignificant on a transaction. Now, if there is a hand up, I don't know whether it's been left from Mark before or whether it's another hand. Someone else wants to jump in online.
Stephen, hello, it's Matt Birrell here. So thank you, it's been very informative. So traditionally, we've done all we can to make sure the equity in a trust is organised and issued prior to acquiring land. Under the new regime, a development trust acquires commercial land with the purpose of undertaking a ready development. Is there an opportunity post sale, post acquisition of the land to reorganise the equity without there being a change in use?
You want to answer, Blake, or do you want me to?
I think that there probably will be some opportunities then. I think if it's acquired after 1 July 2024 and the land is already in the regime, then there should be no reason that you can't transact on the underlying landholder interests if need be. So
before you change
before you
change
change
it,
correct. Yeah.
So it depends on when that change of use happens, Matt, like in that period that we were saying, we're not 100% sure when it'll flip over because once it's residential, then you're back to the normal stamp duty rules.
Yeah, I've made the observation that the clawback, we'll call it, is based on the value of the land on the exempt transaction. So in the example where a fund buys land, pays duty, and the subsequent transactions that are exempt, if it's then converted to residential, it's those exempt transactions which will be assessed.
Talking about this one?
Yes.
Might want to just say that again.
Well, slightly different arrangement, but if you change use here, it goes back to that transaction, the exempt transaction, which becomes assessable, and it's assessable on that date, 1st of July 2026. So if instead of a purchase of land, that was a purchase of units or shares in a landholder, it'd still be on that date, not the original date of acquisition.
So you're saying if the change of use happens because the entry
goes back to the last exempt transaction.
Yeah. Okay.
And just a follow up to that, Rob, is that the case even if at the date 1 July 26, if there was an industrial property that was on the property that was being rented out as industrial, it was subsequently demolished and turned into resi, do you still go back and say on 1 July 26 it was used for resi purposes?
Yes, it's the valuation as at 1st July 2016. So if it happens to have been rezoned in the meantime and has gone up in value, you still go back to 1st of July 2016. 2016.
With the reduction that Blake talked about.
Yeah, with a reduction for each elapsed year.
Thank you everyone for joining us today, and if we give the presenters a round of applause. So I'm sure this will trigger a few things in your mind. If you have any things, please feel free to reach out to one of your SW advisors. Thanks a lot everyone for coming.